When most people begin trading with just $100, their mindset quickly shifts into get-rich-quick mode. They fantasize about doubling their balance within a week, maybe hitting $1, 0 inches a month. And soon after, they're dreaming of quitting their job. This mindset is exactly why most traders don't make it. Turning $100 into a fortune isn't about speed. It's about learning to think in terms of decades, not days. The mindset that makes this journey possible is known as the compounding mindset, the belief that steady, strategic, and consistent growth always outperforms reckless, high-risk attempts at fast money. This approach is grounded in patience, self-discipline, and long-term focus. At first, it might feel dull. It lacks the thrill of placing massive bets and watching your account fluctuate wildly. But it's the same mentality that has built wealth across countless industries, from legendary investors to master traders. It's this mental framework that forces you to protect your capital, grow it gradually, and avoid sabotaging your own progress. The average trader sees $100 as trivial money they're willing to lose. The successful trader sees that $100 as a seed, and you don't consume the seed, you plant it, nurture it, and shield it. If you keep digging it up to check how fast it's growing, you kill it. In trading, this means avoiding the urge to overtrade, to take oversized risks, or to jump into random setups out of boredom. A $100 account deserves respect, because the way you handle a small sum is exactly how you'll handle a large one. Let's break this down. If you grow your account by just 5% each week, that doesn't sound impressive up front. On a $100 balance, that's only $5. Most traders wouldn't even take that seriously. But compound that over time, and the numbers become incredible. At a 5% weekly growth rate, $100 turns into around $10, 0 inches under 5 years. And if you maintain that same mindset as your capital increases, it scales into hundreds of thousands and eventually millions. The concept is simple growth, consistently applied over time, leads to results that initially seem impossible. But here's the issue: most traders don't think this way. They grab that $100 and are ready to risk half of it on a single position. If it works, great, they're up $50. But what they fail to see is that just 2 losses in a row can wipe them out emotionally and financially. This is where the compounding mindset becomes the key difference between those who make it and those who don't. Millionaire traders don't measure success by what happens in one trade or over 1 week. They evaluate progress through a series of intentional, disciplined decisions made over months and years. Take a well-known example, a commodities trader who, back in the 1970 seconds, began with about $1.600 and turned it into hundreds of millions over the following decade. He didn't achieve that by taking wild bets. He succeeded by applying consistent principles and letting time do the heavy lifting. He succeeded by sticking to a set of reliable, repeatable rules for each trade and allowing time to work in his favor. His journey wasn't driven by luck. It was built on patient discipline. That's the mindset you must develop. Even if you're starting with a fraction of the capital he had, embracing the compounding mindset also changes how you interpret losses. Most traders panic when they're in the red because they treat every loss as a personal failure. But someone with this mindset sees losses as part of the overall process accounted for in their strategy. If you lose 2% today, but remain committed to your plan, you can recover that gradually without taking reckless risks. Emotional stability like this is essential, because if one bad trade throws you into revenge mode, the mental battle is already lost. Let's talk about emotional energy. Trading isn't just about reading charts, it's about your mindset when you're making decisions. If you're obsessed with quick gains, you'll constantly feel anxious. Every market move will feel like a crisis. Clear thinking disappears. The compounding mindset removes this urgency. It refocuses you on making the right decision consistently. This not only makes the trading experience calmer, but also enhances your decision-making over time. One of the most common pitfalls for beginners is comparison. They scroll through social media and see someone flipping $500 into $5, 0 inches a week. And suddenly they question everything. But what they don't realize is those accounts often rely on high-risk plays, and many of them crash shortly after. The compounding mindset tunes all of that out. It's about sticking to your personal roadmap, at your pace, guided by rules that don't waver with the market's mood. Here's a simple example. Let's say you have $100 and your goal is to grow it by 3-5% each week. You've developed a solid system that gives you 2 to 3 high-probability trades weekly, each with a 1-2 risk-reward ratio. You risk 2% per trade. That's $2. A win nets you $4. It might seem trivial now, but consistency is the magic ingredient. After a few months, your account grows. At $500, you're making $10 per win. At $5, ling ling ling. That's $100. The strategy hasn't changed, just the scale. There's another major advantage to beginning with a small account. It forces you to develop risk management skills while the stakes are low. Many traders suddenly gain access to larger funds, maybe through savings or a prop firm, and burn through it fast, because they never learn to manage small amounts properly. But if you treat your $100 with care, you're training yourself to treat $100, 000, the same way. The rules don't change, only the numbers do. It's also important to recognize that the compounding mindset is far from passive. It doesn't mean sitting back and hoping your balance increases magically. It means consistently improving your system, learning from your mistakes, and adapting to shifting market conditions, all while staying within a framework of controlled risk. You're not swinging for home runs. You're aiming for steady base hits, day after day, and eventually, those base hits lead to a winning season. Some traders reject this approach because it feels too slow. But think about it. What's the smarter path? Spending half a year chasing fast profits, blowing up multiple accounts, and ending up where you started? Or dedicating those same 6 months to building a foundation of steady gains so that when real capital arrives, you're truly ready? One path brings temporary thrills and long-term regret. The other builds confidence, consistency, and the potential for lasting wealth. Let's be clear. The compounding mindset isn't just about your bank balance. It's about how you see yourself. When you embrace this mindset, you begin to operate like a professional, not a gambler. Professionals work with systems, probabilities, and future goals. Gamblers rely on luck, gut feelings, and that one big break. Markets reward those who operate like pros and punish those who don't. That $100 account, it's not small. It's your proving ground, your opportunity to earn the market's respect. At its core, the compounding mindset boils down to this: safeguard your capital, grow it slowly, and never rush the process. If you can do that with $100, you've already laid the mental groundwork for turning it into $1 million. The dollar amount may grow, but the mindset must remain unchanged. And once this truly sinks in, you'll stop seeing your small account as a restriction and start seeing it as a powerful advantage. In trading, patience isn't just about waiting. It's about waiting without falling apart in the process. Most traders believe they're patient because they can hold a trade slightly longer, or endure a minor pullback. But real patience, ruthless patience, is a different beast. It's when you're watching price hover inches from your ideal entry and still don't take the trade because the setup isn't perfect. It's when you see motion, volatility, and what looks like opportunity, and still you hold back because you know not entering is a form of discipline. This mindset is uncommon because the market is designed to erode your patience. From the second you log in, each candle feels like a temptation. Every price tick whispers, "Act now before it's too late." And if you're not fully anchored in discipline, those whispers become commands and you obey. A trader without patience sees setups everywhere. A trader with ruthless patience only takes trades when the edge is undeniable. I once read about a trader back in 2003 who followed a strict rule: no more than 4 trades per month. Not because he was unmotivated, but because he fully understood that his strategy only produced 4 solid, high-probability setups during that period. In one particular month, he waited 23 straight days without placing a single order. Then, on day 28, his signal finally appeared. He executed the trade flawlessly and made more from that one setup than most impatient traders earned in an entire month. When asked about it later, he said something that stuck with me ever since. "If the market will still be here tomorrow, why rush today?" That quote perfectly captures the essence of ruthless patience. The real challenge is that patience often feels like inaction. And inaction feels wrong when we're conditioned to equate productivity with movement. In a typical job, you're replying to emails, joining calls, ticking off tasks. In trading, however, the most productive move can be sitting still, watching, and waiting. It feels unnatural. Your fingers twitch to click something. Your mind whispers that doing something is better than doing nothing. And that's where traders slip. They jump in early, chasse noise, and take trades that almost fit their criteria. In doing so, they sabotage their own performance. Ruthless patience isn't laziness. It's strategic stillness. It's a deliberate and focused decision to hold back until the exact moment your edge presents itself. This takes mental toughness because the modern world celebrates speed, instant gratification, and hustle. But trading rewards the opposite. In this game, the tortoise doesn't just beat the hare blows up their account. While the tortoise compounds their capital steadily into freedom, there was once a legendary trader in the 1,980 seconds who reportedly earned hundreds of millions, but only placed trades around 15 days a year. Many believed he had some secret weapon, but in truth, his real edge was his discipline. He knew his setups inside and out, and only acted when the market aligned perfectly. On most days, he simply sat and waited. He once described the waiting as about as exciting as watching paint dry, but when the setup appeared, he moved decisively, as if stepping in front of a speeding train with perfect precision. That's what ruthless patience looks like. Waiting for the moment you know will come, instead of chasing illusions. To truly embody this mindset, you must redefine what it means to win. Winning isn't about locking in green days. It's about sticking to your system, even if that means staying on the sidelines. If your strategy calls for specific conditions and the market doesn't meet them, not trading is a win. The impatient trader measures progress in profits and pips. The patient one measures it in avoided losses and preserved mental energy. It's a small shift, but a powerful one, because it takes the pressure off needing to always be active. Now think about the damage impatience causes. Every impulsive entry that leads to a loss erodes your confidence. Each unnecessary mistake forces you to overtrade in an effort to recover, and the harder you push, the worse your decisions become. That's the spiral that ruins accounts. Ruthless patience breaks that cycle before it even starts. It acts as armor, protecting you from your own impulses. Naturally, ruthless patience doesn't come easily. It's not an instinct. It's a skill that must be developed. And it all begins with clarity. Without a precise, clearly defined trading plan, you can't be patient because you won't know what you're even waiting for. The mind craves certainty, and in its absence, it will push you toward anything that looks remotely like an opportunity. But when you know exactly what a perfect setup looks like, it becomes easy to say no to everything that doesn't fit. The sharper your criteria, the easier it is to stay calm amid market noise. Back in 1995, a futures trader named David Haw was under the mentorship of one of the most respected floor traders in Chicago. His mentor once told him, "If you can stand on this trading floor all day and make 0 trades, you're ready to go pro." At first, David thought this was ridiculous. What's the point of being a trader if you're not trading? But after blowing his account twice, he finally got it. The lesson wasn't about avoiding trades altogether. It was about avoiding bad trades. That year, he shifted his entire focus to waiting. He let dozens of decent-looking setups pass, but when his exact entry criteria lined up, he entered with full precision and size. By the end of that year, his win rate had jumped over 40%. Not because the system changed, but because his level of patience did. The toughest test of ruthless patience often comes during drawdowns. When your account is shrinking, it's natural to want to recover those losses fast. The impatient trader will double down, chase risky setups, and try to force the market to pay them back. But the patient trader does the opposite. They accept the drawdown, pause, and wait for the same high-quality setups that got them ahead in the first place. It's counterintuitive, but it's the exact reason patient traders survive and grow, while impatient ones burn out. Patience is also what makes scaling possible. Let's say you're starting with a $100 account. If you're chasing trades, you might flip it to $200 quickly, only to crash back to $50 just as fast. But if you grow it slowly, even 5% in the first month, that growth stacks over time. Small, consistent gains create a foundation strong enough to support larger positions and bigger profits. Impatience seeks fireworks. Patience builds dynasties. One of the hardest parts of this mindset is dealing with the what-if moments. You follow your rules, skip a trade, and it turns out to be a winner. The reactive part of your brain screams, "See, you missed it." But here's the truth. A solid process will sometimes let go of trades that would have worked out. That's not a weakness. That's the cost of long-term consistency. Your mission isn't to catch every single win. Your mission is to take only the trades that align with your edge. The market isn't going anywhere. Missed opportunities don't matter. Violating your rules does. And patience doesn't stop at the entry. It affects how you handle the trade once you're in it. An impulsive trader often cuts winning trades short because they can't bear the thought of giving back profits. In contrast, a disciplined trader holds through to their full target, trusting the statistical edge of their system. This is why patience isn't just about timing your entries. It influences the entire trading process. From sitting tight for the right setup, to letting the trade develop fully, and then waiting again for the next opportunity. Patience is the common thread that keeps your actions consistent. It's important to understand that ruthless patience doesn't equal flawlessness. You'll still occasionally enter subpar trades. You'll sometimes exit too early. But the objective is to make patience your default setting. The more you commit to practicing it, the more instinctive it becomes. And over time, your results will reflect that shift: fewer impulsive trades, a higher success rate, less stress, and greater freedom. If there's one metaphor that embodies ruthless patience, it's the image of a lion crouched in tall grass. The lion doesn't chase every antelope it sees. It waits, it observes, it analyzes, and when the perfect prey steps into range, it strikes with full intensity and precision. That's how you survive in the market, not by reacting to every flicker of movement, but by reserving your energy for moments when the odds are heavily in your favor. Ultimately, ruthless patience isn't just a trading technique, it's a mindset for life. It teaches you to prioritize quality over quantity, to stay loyal to your process, and to resist acting just for the sake of doing something. It's not flashy or thrilling, But it's the reason some traders quietly build lasting wealth, while others self-destruct in a frenzy of overtrading. If you embrace this mindset, your $100 account may not explode overnight. But with time and commitment, it can grow beyond what you thought was possible. One of the toughest lessons traders face is accepting that the market doesn't care about your emotions, your optimism, or your need for a trade to succeed. The market isn't your friend or your foe, it's a reflection of your discipline, or lack thereof. The harsh truth: most traders fail because they let emotions hijack every trade. They treat each position like a personal referendum on their skills, but the reality is, no single trade defines you. What counts is the long-term outcome of hundreds of trades, executed with consistency, not desperation. A trader who risks $100 and loses may feel the pain, but an undisciplined trader feels something even more dangerous: the need to instantly make it back. That's where revenge trading is born. You begin to imagine setups that aren't there. You force entries just to soothe your ego, and every time the market punishes that behavior, you must detach emotionally from every individual outcome. A loss isn't a personal attack or a threat to your worth. It's just part of the process, nothing more, nothing less. I've witnessed traders with exceptional technical knowledge fall apart simply because they couldn't manage their emotions. One trader in particular had a win rate above 60%, but his average losses were double his gains, because as soon as a trade moved against him, he panicked. He would either close the position too early or reverse it entirely. Even when the charts clearly signaled patience, his emotions screamed for action. He wasn't beaten by the market, he was defeated by his own reactions. This is why emotional detachment isn't a luxury, it's a necessary skill for survival. Think of it like this: imagine flipping a coin, knowing that over 100 tosses, it'll land on heads about 50 times. You wouldn't stress if the first few flips were tails, because you understand probability. Trading follows the same logic. If your strategy has a long-term edge, 1 or even 10 losing trades doesn't change the outcome as long as you stick to the plan. But the moment your emotions override your discipline, you stop trading with a system and start gambling. Back in 2008, during the financial meltdown, a trader I knew personally made over $400. 0 inches, 6 months shorting banking stocks. His system was solid, and his timing was precise. But one unexpected reversal cost him $50. Zero pollice a single day. That shook him. He began doubling down on poor setups, chasing moves that had already happened, desperate to recoup the loss. Within 3 months, everything he had gained was gone. He later admitted the market didn't destroy him, it was his refusal to accept that he was wrong. He needed the market to validate him emotionally, but the market doesn't play that game. The mindset you need is one of detachment. That means before you even open a trade, you've already accepted the possibility of a loss. You're not trading to feel right, you're trading to stick to your strategy. If your plan says to cut the loss, you cut it. If it says to stay in until the target is hit, you wait. There's no room for maybe it'll turn around. That's not logic, that's attachment. And attachment ruins consistency. The best traders I know treat each trade like a grain of sand on a beach. They understand that one trade doesn't define the whole. A win or a loss doesn't change the big picture. They don't get overly excited when they win, nor do they spiral when they lose. They remain grounded, focused entirely on process, not short-term results. That's the key: process over outcome. Because the moment you begin measuring your worth by one result, you let your emotions take control. Detachment also means checking your ego at the door. Your trades are not a reflection of your value. A losing trade doesn't mean you're incompetent, just as a winning one doesn't make you brilliant. Ego wants to prove something to the market. But the market couldn't care less about proving anything. Ego has a sneaky way of keeping you stuck in bad trades simply because you don't want to admit you were wrong. But the market rewards those who can acknowledge mistakes quickly and move forward. A humble trader who cuts losses immediately will always outperform the proud one who holds on out of stubbornness. There's something I always emphasize to new traders. Your role isn't to predict where the market will go. Your role is to manage risk while giving your edge room to perform over time. That's it. Once this becomes clear, losing trades stop feeling like personal failures. They just become part of the business. Think about running a restaurant. If a few meals get tossed because of cancellations, you wouldn't shut the whole place down in frustration. You'd keep going, knowing that profitability comes from consistency and execution. Trading is no different. Losses are simply a business expense. In 1995, a little-known trader from Chicago began with just $2. 0 inches capital. He traded options and barely broke even during his first year. What made him different wasn't his strategy, it was his mindset. He didn't obsess over individual wins or losses. Instead, he focused entirely on refining his process. To him, every trade was a measure of discipline, not intelligence. By 2001, that same $2, 0.00 had become $3 million. When asked about his success, he said something that stayed with me. I stopped needing the market to make me feel good. I just needed it to follow the math. That's pure emotional detachment. The good news is, this mindset can be developed. The first step: define your risk before entering a trade. If you're comfortable losing $50, accept that outcome before you hit buy or sell. That way, when the loss comes, it's not an emotional blow, it's just your plan unfolding. Second, always keep your attention on the next opportunity, not the previous one. Whether you won or lost, the last trade is history. The next one is all that counts, and how you execute it matters more than how you feel. Third, keep your position size small enough that a loss won't shake your confidence. If a trade makes you anxious or clouds your thinking, you're likely risking too much. Reduce size until your emotions stay in check. When you remove emotion from the equation, something shifts. Your decisions become more precise. You stop forcing trades. You stop second-guessing. You follow your system with focus and clarity, and over time, the market begins to reward that consistency. Just remember, the market can be unforgiving, but it's not biased. If you make sound, disciplined choices consistently, the math will eventually swing in your favor. But if you let emotion take control, the market will keep handing you the same painful lesson until you either adapt or give up. Emotional detachment doesn't mean you stop caring about success. It means you value discipline more than the outcome of any individual trade. It's the same mental approach used by professional poker players. They understand that even with a strong hand, they might lose, and sometimes with a weak hand, they might win. But what matters is that they consistently execute their strategy. That's how fortunes are made from modest beginnings. That's how a $100 account grows into $1 million over time. And that's the part many traders overlook. This game isn't about forcing the market to behave the way you want. It's about reshaping your own mind to thrive in uncertainty. When you stop needing the market to give you emotional reassurance, you unlock the ability to trade based purely on logic and probabilities. And that freedom, the absence of emotional dependence, is where lasting success begins. Markets are dynamic, living entities. They shift, they evolve, they punish arrogance and reward flexibility. The mental edge that keeps you in the game is called relentless adaptation, and it's what separates long-term survivors from those who get wiped out. Winning isn't about predicting the future perfectly. It's about responding when the present changes unexpectedly. The traders who last long enough to turn small accounts into life-changing capital Understand this: nothing stays the same in the markets. Not trends, not volatility, not price behavior. Often, the moment you start feeling overly confident in a strategy, the market changes, and that very approach becomes ineffective. Here's the trap. Your brain is wired to seek comfort. It wants you to stick to what feels familiar. But in trading, comfort can be dangerous. In 2008, when financial markets collapsed, to traders relying on slow, long-term strategies were blindsided. Those who pivoted, quickly shifting to short-term plays, adjusting risk, and exiting faster, not only survived, they thrived. They didn't waste energy blaming the system or hoping for a return to normal. They accepted the new reality and adapted immediately. That's the mindset. True adaptation means you never get attached to a specific strategy. You treat every method as a tool, not an extension of your identity. When the tool stops working, you don't cling to it. You pick up a better one. Many traders fail because they confuse consistency with stubbornness. Real consistency is about sticking to strong principles over time. Stubbornness is resisting change, even when the environment demands it. This mindset also requires you to check your ego every single day. Ego will have you believing you're smarter than the market. It'll whisper that your analysis is flawless. It's that inner voice telling you to hold on a little longer. It'll turn around. Ego cares more about being right than being profitable. A trader with the mindset of adaptation doesn't care about being right. They care about results. Just look at nature. Survival belongs to those who adapt. When the environment evolves faster than a species can adjust, extinction follows. Trading is no different. Your strategies, your risk levels, and even your schedule must change as the market does. There will be months when you're trading aggressively because market volatility is high and opportunities seem to be everywhere. And there will be other months when you're barely taking any trades, focused on preserving capital because the setups just aren't clear. Either way, you adjust without guilt, without frustration, and without the fear of missing out. One of the most effective ways to cultivate this mindset is to view every market environment as a teacher. When the market trends, it's training you in momentum discipline. When it moves sideways, it teaches patience. And when it becomes erratic, it reminds you to control your risk. Weak traders complain about market conditions. Strong traders analyze them, adapt, and take away lessons that sharpen them for the road ahead. The real key is making adaptation part of your default behavior, not something you only do when cornered. If you only adjust once you're under pressure, you're already behind. You should be testing different strategies, exploring various time frames, and experimenting with risk parameters before the market forces you to. That way, when conditions shift, you're ready. It's just like a fighter who trains in multiple combat styles. No matter who steps into the ring, they've got a response. In 1995, there was a trader named Marty Schwartz, a well-known figure in the stock index futures world. He was already successful. But when he sensed the game changing, he didn't cling to old methods. He expanded his toolkit, explored different markets, and even adjusted how much risk he was taking. That mindset of evolution kept him profitable. While others who stayed stuck in their ways lost it all, his edge wasn't just skill, it was his refusal to stay stagnant. Relentless adaptation also means getting comfortable with discomfort. Progress only happens when you willingly face uncertainty. If you only take trades that feel safe, you're capping your growth. The market will constantly test the edges of your comfort zone, sometimes by speeding up, sometimes by shifting direction, other times by doing nothing at all for weeks. Your job isn't to fight it, it's to flow with it. And here's what most traders overlook: adaptation isn't only about your system or strategy. It's also about your mindset. Some days you'll be sharp, dialed in, ready to execute. Other days, You'll be off tired, emotionally distracted, or unfocused. The adaptive trader recognizes this and adjusts accordingly, scaling down, trading less, or sitting out completely. They adapt not just to market conditions, but to their internal state as well. This mental flexibility is the final, crucial layer, because without it, all the discipline, patience, and emotional strength you've built can collapse under the weight of your own rigidity. The market has no obligation to reward your favorite setup. It doesn't care if your method worked perfectly last quarter. It's not moved by your opinions. It rewards those who can bend like water, flexible, fluid, and forceful when needed. If your goal is to turn a small account into something truly substantial, you must be willing to evolve again and again, becoming a better version of yourself with every change the market throws your way. Every stage of growth requires a new version of who you are. The novice learning how to manage risk must evolve into the intermediate trader who can regulate emotions. That trader must then transform again into the advanced trader who reads market behavior almost instinctively. And even then, the evolution never ends. At times, adapting will feel like going back to square one. That's completely normal. Every pivot you make sharpens your survival instinct. You're reminding yourself that you're not here for fast wins, you're here for the marathon. The trader who turns $100 into $1 million isn't the one who discovers some flawless strategy. It's the one who continually reinvents themselves. Point shifting form as often as needed to stay ahead of the game. So etch this into your mindset: the market owes you nothing. It doesn't hand out rewards just for effort. It rewards those who can evolve. The trader who thrives isn't the one who goes to war with the market and wins. It's the one who moves with it so seamlessly that fighting becomes unnecessary. If you've absorbed all the principles laid out so far, you now hold the 4 key pillars: discipline, patience, resilience, and the ability to adapt without hesitation. Master these, and your small account will no longer be limited by its dollar amount. It will only be limited by your mindset and how far you're willing to grow. Always remember, the market reflects who you are. If you're inflexible, it will snap you. If you're adaptable, it will carry you forward. Be the kind of trader who bends like, adjusts, and evolves endlessly. That's how you survive. That's how you grow. That's how $100 becomes a fortune. Now, I'd love to hear from you. What's the biggest shift you've made in your trading mindset, and how did it influence your results? Share your thoughts in the comments. I go through every one.